Right now, in your 30-year fixed rate mortgage, you are getting ripped off. That's right, you're getting hosed. Tens of thousands in interest, if not hundreds of thousands in interest that you just don't have to pay. 30-year fixed rate mortgage is actually 360 payments. So what you borrow in the beginning, you pay back over triple basically at the end of what you borrowed. Now, if you don't follow these strategies, you're going to end up giving tens, if not hundreds of thousands of dollars in interest that you don't have to give to the bank and line their pockets instead of yours. Before we get into it, I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner. That's right, three-peat winner of NAMI Broker of the Year, top originator across the country via Scotsman Guide, and just an all-around mortgage guru. All right, check it out. Let me give you an example with one of my friends, actually one of my good friends, husband and wife couple, of they bought a house and they're just not doing any of the strategies that we're about to discuss to save money. So they found this house that they loved. House was about $800,000. They were able to put down a healthy down payment, $300,000. So they got a $500,000 mortgage. Now, mind you, this is the type of couple that waives the home inspection to try to get the house. And, you know, there's all sorts of stuff that went wrong with the roof, which we're not going to talk about in this video. But that $500,000 mortgage at a rate of 6% was a $3,000 a month mortgage payment just for principal and interest. Now, one of the easiest strategies to deploy is called the biweekly program, which we're going to get into in a little bit. So the biweekly program is most, if not almost all, W-2 employees in this country are paid biweekly. And that means there's 26 bi-weeks in a year instead of 12 months of bi-monthly, which is like the number 24, right? So for all intents and purposes, 26 paychecks they each get. So if we would have put them into this biweekly program, they would have had one extra payment for the year. So now $3,000 a month. If you do the biweekly program, you save 4 years. That's right, 4 years off your mortgage. And to the average person, like, oh, what's the big deal, Andrew? So do the math with me, right? $3,000 a month for the mortgage payment times 12, the amount of months in a year, $36,000. That's a 36,000. It's a lot of money. Now take that, times that by 4, that's over $140,000. So they opted not to do a quick and easy program to save over $140,000 in future payments. You know, sometimes being a know-it-all in some cases might be good, in some cases might be bad. This is a case where it's actually not that good. But I hear you right now saying like, hey, Andrew, I don't have any extra money to throw towards the mortgage. It's actually wrong. You know, as the case is with my friends, you know, the couple we were speaking about, they could have went into a different program. They could have went into a biweekly program. It's not costing them anything more per se out of pocket. It's a quick and easy fix. So it doesn't require more money. Or, hey, Andrew, I don't have the time to settle this up. My life is super busy. Well, if you have time to hop on Uber Eats and get yourself consistent Chick-fil-A, guess what? You got plenty of time to save yourself $140,000. So I showed an example of my friends that were too cool to save over $100,000 in mortgage payments with a quick and easy program. And we talk about all the haterade, right? Like you're needing more money per se to do this, or it's a big drama. It's actually not. So I'm going to give you 5 ways that you can save right now on future payments and on your mortgage, and you won't really feel it. Now, the first way, of course, the most popular, ding, 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 is the biweekly program. Now, again, if you're a W-2 employee in America, typically, which is most companies paying their employees W-2, there's biweekly payments being given to their employees, which is 26 checks you as an employee receive from your employer. Now, whatever your yearly salary is, you divide that by 26. That's what you're getting every other week. Now, if you look at a monthly mortgage payment, if you cut that payment in half and times it by 24, which was the number 12 months in a year, cut that in half, right? So you're doubling the 12, that turns into 24. By having 26 biweekly payments, if you take your mortgage payment, cut it in half, and now pay it every other week, that extra 2 payments that you're making equates to 1 extra mortgage payment additional for the year. Now, believe it or not, it doesn't sound like it's going to change your life, people, but that extra payment per year cuts off 4 years. In that real life example of my friends, a $500,000 mortgage with a rate of 6%, which is $3,000 a month. $3,000 a month times 12 is $36,000 of payments for the year. And then times that by 4 lost years, you're going to save over $140,000. And that's why the biweekly program is so simple. So if you're a W-2 employee and you have a mortgage, you are crazy not to do the biweekly program. Now, the second way is just doing a lump sum, where you take a certain lump sum at a certain time of the year and you chunk it into the mortgage, and it goes towards principal, which is knocking down the balance instead of interest. Now, take, for instance, if you're a W-2 employee and you don't want to do the biweekly program, it's too much drama setting it up, I get it. You're going to take your tax refund and take a portion of that and pay down the mortgage. So just as in the biweekly program, there's one extra payment a year, that extra $3,000 in this example, if you take a lump sum once a year for $3,000, say each year, some people at work, they don't have a lot of deductions and a lot of money's taken out of their check from the IRS side. But when they true up in tax season the following year, they get a lot of money back, and it's just like a forced savings for them. So say they, on average, the average person or couple gets back $10,000 as a tax refund. If you take $3,000 of that $10,000, chunk it into the mortgage, it's the same net effect. It'll save you the 4 years and the $140,000 in payments. So a lump sum is a great option as well. A third super simple option is just to round up your payments. So again, in this example, if the payment's $3,000 a month and you want to make an extra $3,000 each year, if you add an extra $250 a month, which isn't all that much when you're paying that high of a mortgage payment, that extra $250 or $32.50 a month as an auto pay will give you that one extra payment a year. So all you have to do is take a deep breath. It's going to be okay. A little woo-saw. Take a step back and say, what can I do by rounding up my payment so I have enough money each month after 12 months that it's one extra payment, which will, again, knock off the 4 years. In this example, over $140,000 in mortgage payments. So this is a super popular example, the third one, of just simply round up the payment a little bit and do that each month. The fourth option, something that's even more popular we've seen, is if you're a W-2 employee and you make, say, $10,000 a month, right? $120,000 a year. You should net, depending, right, $5,500 to $6,500 after taxes, depending on deductions. If you are single with no dependents or you're married with a boatload of dependents, let's just go off of, for instance, $6,000 a month is what you net after taxes. Now that $6,000 a month, say a portion of that goes to your main account, say $5,500 goes to your main account. Now you take $500 of that and you put it to a side account. So you can set up with your employer that a portion of your actual income, whether it's biweekly or monthly, whatever it is, goes to a side account. And that's almost a forced savings account to pay off your mortgage again. Pay it a little bit early. And then if you add that up over the year, the same net effect could happen. So again, if, say, for instance, you make the $6,000 a month after taxes, and in our example of the $250 a month extra, you take $250 for the month, put it in a side account, just so you don't necessarily feel it. You could take that side money, do the same thing, pay off the mortgage, each month pay a little bit more, and after a year, same thing happens. You save the 4 years. You see the trend here, right? You save the $140,000. So set up multiple accounts at your employer, and a portion will go to a side account used to prepay your mortgage. It's an amazing idea. Now the fourth way, which depending on where the rates are, many people don't necessarily opt for, is if you have a 30-year fixed rate mortgage. Say you're, in the case of my friends, 2 years into it. You have 28 years left. Maybe, just maybe, you can go into a 20-year fixed rate. Now, you'd have to refinance, of course, a 20-year fixed rate mortgage or a 15-year fixed rate mortgage. Now, oftentimes, the payment goes up. So follow the math. If you go into a 20-year fixed rate mortgage and your current payment right now is $3,000 a month, and say the new payment is $3,500 a month, that means for 20 years, you're going to have $500 more a month in payment. So $500 a month times 12 is $6,000. 6,000 times 20 years is $120,000. Why would you ever want to pay $120,000 more? What are you, crazy? No, you're actually not crazy. You're super smart. You follow the advice of good old Andrew Russell. So those 8 years that you're going to lose, that $120,000 in additional payments, those 8 years, that's $3,000 a month times 12, $36,000. Now $36,000, let's round up to 40, is about $300,000 over 8 years that you're going to not pay. So that $300,000, let's just say, minus that $120 of additional payments, you net out $180,000 of net savings of payments you don't have to make. So it's a clear example. Although your payment goes up slightly for a shorter amount of time, you're cutting off the back end of such a high payment for so many years. The net savings is boatloads of cash. And that's the fifth way. Not as popular right now, only because of where the rate environment is. So here you are, guys. You saved all this money, you listened to your boy Andrew Russell, and now you have, in the case of this example, $140,000 of cash on the sideline. It's time to invest it, that's right, in another house, in an investment property. Let's get some cash flow. Let's get some passive income. But so many mistakes are made in the home buying process. So what we're going to do is in our next video, make sure you watch our next video, guys. We're going to go over all the typical mistakes by all home buyers to give you all the tips and strategies so you can avoid them.